You know, we've heard since the pandemic began a variety of terms to describe what's happening in the labor market. We started off with quiet quitting, and we've had others, by the way, including quiet firing, which I think we just talked about a week or so ago. Mm-hmm. But one thing we didn't talk about a lot at the beginning, but we're starting to hear a whole lot more about it now, is quiet retiring. You know, we have an aging population to begin with, and a lot of people, even during the pandemic, decided, okay, this is an opportune time to walk away because, well, those jobs are not here anyway. But the problem is we're finding out with labor shortages across the country, some of those people who retired early, we need them to come back. There are that many job openings. So we try to find out more about this. Jimmy Jean is chief economist at the Desjardins Group. He's on the line right now. Mr. Jean, thanks for your time today.
Well, thanks for having me.
So let's try to fill in some blanks here. When we say quiet retiring, what exactly do we mean here by that?
Yeah, well, it's a concept that people have kind of used to link the quiet quitting with what we're actually observing in terms of the great retirement that seems to have caught on to Canada. It's a trend that we saw right at the onset of the pandemic. We saw a huge wave of people aged 55 and above in the U.S. Exit the labor market as they were either concerned with catching COVID, but also as their wealth improves in such a fashion that they could afford to leave a little bit earlier. Now, we didn't see that occur at the same time in Canada, but right now, the latest information we have from the labor market for Statistics Canada, it shows a pretty clear decline in the participation rate for people aged 55 and above over the last year and a half or so. And it is a trend that is expected to continue given, especially given population aging.
Is it an age-appropriate retirement, or are we seeing people retire at an age earlier than would have been expected?
Well, yeah, the fact that we're seeing less people 55 and above involved in the labor market suggests that people are taking their retirement a little bit sooner than they used to. And we're seeing those trends prevalent, especially in BC and in Ontario and to some extent in Quebec as well. So this is certainly something that's you could see as a positive for the people who are able to afford a retirement earlier and benefit from more years with a decent quality of life. But at the same time, from an economics perspective, we're at a stage where workers are missing. It's leading businesses to scramble to try to find people. It's leading to a lack of services in the economy, and a lot of business overall that gets missed because, for example, shops have to close earlier, or because they can't open their doors on certain days because of lack of staff. You hear a lot of about that, especially in regions and smaller communities. So it comes at a cost from a society's perspective.
Which kind of begs the question, I don't know if there's an answer for it. If we have a labor shortage and people are retiring in bigger numbers than they were before, what's a government to do to try to get those people back in the labor force, given that we have all these jobs that need to be filled?
Right. Well, there's been a lot of focus on the financial incentives. That's typically the first place the governments will look at. So the fiscal incentives, credit, tax breaks, and also credit to encourage people to stay in the labor force a little bit longer. That's been tried. We can't say that it has been usually successful. There's two things, actually. The first thing is that, for some individuals, the more they age, it's more difficult to really convince them to stay in the labor market. As you age, the value of your time becomes very significant. And for many people, they don't care about, being that much comfortable. They're ready to accept a lower level of comfort if they can have the luxury of doing what they want with their time.
Right.
And then secondly, it's the fact that you can't convince people in any sector of activity to stay in the labor market even if they wanted to. For example, very physical jobs, It becomes very difficult when you're older. For example, in construction industries, it's very difficult for individuals to stay past a certain age. So, there's a limit to what we can achieve with those programs.
So what sectors are in the most desperate situation right now? You mentioned construction. I'm thinking certainly teachers and nurses.
Yes, absolutely. Those sectors, those essential sectors, the labor shortage has been very acute for quite some time. You're talking a lot about accommodation at food, so hotels and restaurants, catering, entertainment as well. Those sectors have been struggling with high labor shortages. They've increased wages to try to attract younger individuals, but the fact of the matter is we just don't have enough young individuals to replace all the people that are retiring and that are going to be retiring in the next few years and even decades. So, obviously we need more immigration. That's a known fact. For the moment being, given, it's simple accounting. And, at the end of the day, you find yourselves with all those job vacancies that can't find workers to fill them in. And it pushes wages higher, and that's a significant cost for businesses.
Yeah, and here we are mired in kind of this spiral of inflation, cost of living going up, and at the same time as we have this labor shortage. Bank of Canada keeps raising interest rates, trying to slow inflation down. I'm seeing the R word more than I have in a long, long time, recession, being talked about on a almost daily basis. Mm-hmm. What does it mean if that begins to happen? What happens to Canada's economy at that point?
Right. Well, for us, it's unfortunately a foregone conclusion. We think the economy is going to experience a recession that's likely to be mild in the first half of 2023. But nonetheless, as you mentioned, central banks are pressing ahead. They're not just going with very aggressive rate hikes as we've seen through the summer, but their communication indicates pretty clearly that those aggressive hikes will continue so long as they're not seeing convincing signs on the inflation front. So what that means, yes, it means that we're going to see a cool down in demand and consumer spending. We're already seeing a pretty significant cool down in the housing market, and that will in turn push the unemployment rate a bit higher, we think, in 2023, and ultimately that will, cool some of those excesses and that overheating that we're having in the economy. Because what inflation says is that your economy is overheating. So we expect that to unfold over the next several quarters.
But it sounds to me like in the meantime, in the short term, we need to brace ourselves.
Absolutely. It's time to be more careful, to be careful about spending, to save more, and really to make sure that, your job is stable. If your job is vulnerable, now is not time to make big ticket purchases or to load up on debt. It's a good time to pay down debt now that the cost of credit is going up. But, generally speaking, it's really the time to be defensive for consumers, and being defensive is what will really solve the inflation problem.
Yeah, and being defensive not for a month or two, as you said. This may last, nobody knows, obviously, but this may last beyond a year, possibly even longer than that.
Yeah, we think it's going to be 6 months, but certainly if central banks are forced to hike even more than we think, we could think of something a little bit more protected.
Jimmy Jean from Desjardins Group. Mr. Jean, thank you so much for your time. Appreciate it.
Appreciate it. Thanks.